Hello and welcome to Switzer. I'm Peter Switzer, and we're looking at a market affected by some real strange things. Who would have thought Donald Trump would have given Mexico a warning to fix up its drug lord situation and the immigration to America with the punishment of a 5% tariff on everything that's sold into America? And then on Sunday, the Chinese came out with a white paper which basically said if Donald Trump doesn't start behaving nice in the negotiations, they'll put American companies on a blacklist, which will really affect companies like Apple and FedEx and whatever. So really interesting times. Not surprisingly, our stock market was down about 1.1%. And we'll be talking to Michael McCarthy and Julia Lee to see what actually happened today, the winners and losers. We've got a very interesting interview, which I did last week with Geoff Wilson from Wilson Asset Management, or Wham. Geoff's one of the best fund managers in the country, historically has been seen that way, a legend of the industry. He'll give you some perceptions about how he invests. And then finally, we catch up with Charlie Aitken of Aitken Investment Management and my colleague Paul Rickard from the Switzer Report. And they'll look at some of the big issues affecting investing right now, and they'll give you their best stocks as well. That's the show for tonight. It's that time where we catch up with Julia Lee from Bell Direct and Michael McCarthy from CMC Markets to see the winners and the losers on the market today. Guys, thanks for joining us.
Pleasure.
Let's start with you, Julia. And look, when I woke up, I knew the market was going to be down. The Mexican standoff, that was a bit of a shock on Saturday morning when I was doing my Switzer report. And then Sunday, the white paper from China saying basically a white paper that predicts a black list. I like that. What was the main drivers of the market's negativity today?
Well, once again, it's trade tensions which are driving the market, but I think it's amazing that the market's now pricing in a 50% chance of a rate cut in the US in July, and further out in the year, 90% chance of a rate cut over in the US by the end of the year. Yeah. That, of course, has implications for Australian investors as well, because the Reserve Bank is looking at cutting rates. So perhaps they need to cut a bit more aggressively if we start to continue to get that softer data coming through from the US. So look, the market is starting to price in a slowdown here. So the added volatility means it was very much a risk-off day.
Yep. Michael?
The concerns are that the moves on Friday out of Washington represent an escalation and a widening of the trade dispute. And both Washington and Beijing up until now have pretended at least this is about trade and economics. That was laid bare on Friday when President Trump linked tariffs to unauthorised immigration through Mexico. It illustrates exactly what a lot of commentators have been saying. This is about politics, not economics. And while markets were prepared to wear it when it was just between China and the US on the basis there'd be short-term pain for long-term gain, a resetting of the trade relationship, the fact that it's been so laid bare that this is about politics, I think, is what really spooked markets on Friday night and what hit our region today. But it wasn't all doom and gloom, Peter. For example, today, the Kospi, the Korean index, gained 1.33%.
Why?
I think there's a view that some Korean companies will benefit, particularly steel manufacturers, will benefit from sanctions between the various US trade partners. And of course, we've seen the same thing happen with Linus here over the last couple of weeks. Its shares have shot higher on talk that there'd be moves against
She bought it a couple of weeks ago. Didn't tell us. Thanks, Julia. Go on.
But there will be winners and losers. Today, the market was only looking at the losers. I suspect we'll have a rethink over the course of the week.
And I guess what didn't get a lot of attention is that we did see President Trump also taking away the developed nation status of India. And India was importing...
He's picking on everybody.
And that's the problem. He's not just picking on China. It's a much wider net now. And India was exporting, I think, just under 2,000 goods to the US duty-free. So that kind of takes away the duty-free status of some of the Indian goods. So the problem is that the market is seeing a much broader implication than just US-China trade. And now we've seen Mexico as well as India being caught up.
And Michael, I'm just thinking about the Cosby thing. See, a company like Samsung competes with Apple, and Apple could easily put on the blacklist, which was a suggestion that came out of the white paper from China.
An unreliable company, very possible. And of course, it's about those supply chains that run deeply through Asia, through China, into the US that we could see significant disruption. So yes, it wasn't just steel stocks that ran in Korea today. It was good support across the board. In fact, I think 9 out of 10 official sectors finished in the green in Korea today.
I've got to bring this up because you were hoping that a breakout might happen, and if Donald Trump wasn't escalating trade wars, I wouldn't even be questioning your brilliance in future forecasting. But are you questioning your own brilliance?
Well, Peter, let's be clear. The market makes fools of us all at some stage, right? That is the nature of trying to. One day it could, Peter. Just letting you know, letting you know it could. Yeah. But well, look, it's not over yet. Remember too, we had month end last Friday. Yeah. So in a down month in the US, most fund managers will be in a position where they want to cut losing positions at month end. Yeah. So we could easily see a bounce back in the US tonight. And if we do, we'll basically hold that support breakout level for the Australian market. So I'm not giving up hope yet, Peter. I'm only going to be wrong once on this one.
The Australian market also has done really well over May. Unbelievably well, really, hasn't it?
Well, we've outperformed all of the major markets. May tends to be the worst performing month of the year for the Australian share market, but not this year. We got the post-election bounce, and that compares to, the US stock market, the Chinese stock market, the Japanese market, the UK market, the European markets, which were all trading lower. So an impressive performance from the Australian share market. What it now needs to back it up with is improving earnings growth, and we're not seeing that quite yet here in Australia.
We need to have economic growth to support profit growth, don't we? Rate cuts tomorrow. Do you think it's going to happen, Julian?
It's Christmas for economists, isn't it, Pete? I mean, we haven't seen a movement by the RBA in 2 years, so it's going to be pretty exciting
I can do a tweet tomorrow at 2:31.
You have to be quicker than that.
Sorry.
Maybe
answer
2:29.
Yes. Yeah.
But the market's baked in that 25 basis point cut. The big question is going to be Philip Lowe's speech on whether he's going to sound more hawkish or dovish. And hawks, fly up in the air and soar, and you don't want interest rates to soar if you're a home owner. You want them to be dovish. So that's going to be the key to how the Aussie dollar reacts as well as the market reacts and the outlook for interest rates. But
But you're betting on a rate cut tomorrow?
I think everybody is.
Yeah. No, I'm not.
You're not.
Wow. I think.
And you haven't been drinking today.
Exactly. Well, not yet, Peter. But look, I'd agree it's more likely than not. But I don't think it's anywhere near as clear cut as the market thinks. I know something like 97% of economists think that there will be a rate cut tomorrow. I think it's much more like 60-40. And given that it's baked into the market, that's the way I'll be trading. Now, this doesn't have huge investment implications, but for example, I think the trade tomorrow will go into the decision long the Australian dollar. Because if we do get the rate cut that was expected, it possibly won't fall too hard, but if we don't get it, that will be a big surprise, and we could see a very strong rally in the Aussies.
Yeah. The only thing usually I would agree, 99.2%, not 100%. But I've never remembered a Reserve Bank governor
signalling.
Yes. And you're young enough to remember a Reserve Bank governor. I can't remember.
Remember the Fed only started talking to the market in the 90s, and the other central banks followed. So this is quite new in market terms. But the question is, do the central banks around the globe, and this looks like a coordinated effort, do they actually want to cut rates, or do they just want to send a signal to policymakers, to investors, to markets generally, that they're ready to move if they have to?
We could be talking to a genius here, an absolute genius. We'll find out by 2:30 tomorrow, or 2:30 plus 1 second tomorrow. All right, now guys, let's talk about what you like. We always do winners and losers. What were the standout winners today, Julian?
Gold and property. When there's volatility, it's safe haven players, especially in the face of interest rate cuts. You're looking at those bond proxies. So property continued to do extremely well. And I guess those high dividend stocks will continue to see and act as a bit of a buffer against the market, especially if there's any resemblance of earnings growth in there as well. So if you've got a combination of even small earnings growth, reliable cash flow, and a strong dividend yield, you're a winner in the market.
And the goal was because of the fear of a trade war escalation and ultimately a recession.
Safe haven. Who doesn't love gold during volatility? So very much a safe haven play, like the Japanese yen was, and the Korean Kospi acting a little bit like a safe haven asset in these times of uncertainty.
Big winner today was Eclipse Group. Now, this car leasing and administration services group have been under severe pressure, and their share price is terrible. For the second day in a row, after management reset strategy last week, they've rallied strongly. From my point of view, Peter, this is a selling opportunity. If you've been stuck in Eclipse Group, this is the chance to get out, because in that strategy, I didn't see anything that addresses the key issue, that most of their businesses are first-generation internet businesses, and they're just as vulnerable to disruption as traditional businesses now. We're well beyond the first generation. So I think it's an opportunity to get out, but you can't dispute a 20% gain on a day like today is pretty impressive. The one I did like today, Peter, was Costa Group. And this
Well,
one,
it was clobbered
it's
last
been
week.
hit very, very hard. And the reason was they were promising earnings growth, and they've now had to come out and tell the market they don't think they're going to get it.
Crumbly raspberry.
Yeah.
Yeah.
But
Well-
a
Crumbly raspberries,
Raspberries.
which impacted on yield.
I
so
said
you
they weren't
don't get it.
firm, they were
Yeah, they
fall apart
crumble,
raspberries.
so you
I
don't
said.
get as
The
much
fruit
yield.
flies as well, they
And
know.
citrus, yeah.
Well, but the
flies.
citrus is a cyclical bit, and this is there's definitely, I'd argue, been some missteps. There's been some bad luck, but I think there's also a misunderstanding of the cyclical nature of a lot of their businesses, and this will kick in next year. So the time to, and I like their China strategy, right? This whole pure foods into China, I think long term is something I want to hold in my portfolio, and I do. I should declare that,
Yeah.
Peter. But I think this is the opportunity. I don't think it's going to stay below $4 for too long.
Do you like the Costa Group?
Yes, I do think that the time to buy agricultural companies is on bad news. However, this is also the second profit warning that we've seen this year. We saw one back in January and we've seen one now. So I'd just wait for the third one perhaps to come. They usually come in threes,
Yeah.
generals. But Eclipse, I got out too quickly. I bought that one 65 cents and got out at $1.06 thinking I did really well. And now, we've seen the stock at $1.30. And the reason why the share price...
So sorry for you,
I
Julia.
know, sorry for me too. It's ever since my husband gave me a monthly budget, I've been trying to increase that through trading.
Real incentive.
Yeah, great incentive. But Eclipse.
But you're on a fabulously big pay, so what do you budget from your
Exactly.
husband?
You should, I'm trying. With Eclipse Group, I think that the market had been pricing in a possible capital raising, which was why the shares had been so depressed. But after this first half update, I guess its balance sheet had gotten better, so it doesn't look like
Okay.
capital raising.
Let's just help people who might be thinking about an investment strategy. Given all the curveballs out there at the moment from Mexico and China and Donald and India and everything, is it a time to, and given the fact that we've done so well, is it a time to wait for a buying opportunity, or do you think that buying opportunity won't be very deep and the market will kick again? You first.
Well, for running a long-term portfolio, I've got a list of quality companies I want to buy at depressed prices, but I don't want to miss out on gains. So I've still got a lot of cash, but I also bought some call options last week. So if the market does continue to run, those call options will increase in value. I'll get the benefit, and I can still afford to wait until quality companies, Costa's on my radar, one of those, until they get to share prices where I'm happy to pile in for the longer term.
Yeah.
So that cash plus calls.
Yep, Julia.
I think from an asset allocation point of view, the US has been a really popular investing destination, and it's time to pull back a little bit
Yeah.
if you're invested in the US. Australia and the US's cycle is quite different. So Australia, we've seen the slowdown sooner than the US, so probably more defensive type of strategies if you're looking here, especially given the rate cuts down the track. You're not going to get much in terms of cash, so you're looking for high yield, reliable cash flows, areas like the property sector, the utility sector, and the consumer staples sector.
Sounds like you're
will be-
advocating the Switzer Dividend Growth Fund there,
Yeah,
but I know you
well,
wouldn't do
it should act as a buffer from the storm.
That's
the
right.
high
That's
yield.
why we did it. I'm a safe investor. All right, guys, thanks for joining us on the program, as always. Michael McCarthy, CMC Markets, and Julia Lee. We'll be coming back in a moment with an interview with Geoff Wilson, who I caught with late last week, and his insights on investing should not be missed. Geoff Wilson, thanks for joining us.
Good to see you, Pete.
Mate, it's always great to talk to someone like you because you've been watching markets, you've been playing markets for a long time. And a lot of people have a lot of nervousness at the moment because the Trump trade deal is not being brokered as quickly as people hoped.
Yes.
And there's also bond market concerns as well. And this week we learnt that JP Morgan's got a little bit more negative on the US economy because the trade deal is not being sorted out. Are you worried about those things?
I suppose the funny thing is, being an investor, I'm always worried. and what we know is, because we've been around long enough, that that bull markets tend to climb a wall of worry. Yeah, but what we also do know is, that bull markets don't last forever.
Yeah.
And after the bull market, there's a bear market. Now go back last year, I was super bearish. And I thought the market could
When I
fall.
talked to you, you were
exactly,
bearish.
yeah. I thought the market could fall 30 to 40%.
Yeah.
And the reason I was super bearish was three reasons. One is interest rates were going up
Yep.
in the US, and we thought there was going to be 2 or 3 more interest rate increases.
Yep.
Also, all the leading indicators then were showing the economies were slowing.
Yep. Worldwide.
Yeah, exactly. And probably the thing that worried me the most was quantitative tightening had started in the US about a year earlier. and really wasn't a big focus. And we all know what happens. Well, what happened with quantitative easing, where $15 trillion was pumped into the global economy. It was very positive, for asset prices. And then, if the US was going to take 3 to 4 trillion out, then in theory it's probably similar to what has happened in Australia, where with the housing market, when you take money out of the system,
because APRA stopped banks from lending.
Correct. Yeah. What happens is asset prices fall, and so those three factors, and the biggest one that I was concerned about was the quantitative tightening. Now we all saw,
and that's from the Fed in the US in particular.
From the Fed, and we all saw them do an amazing 180 degrees turn in January/February, and then what we did see is China pump in, I think it's 8.2 trillion RMB into their economy in the first quarter of this year. So interest rates weren't going up anymore. Quantitative tightening was off the table, and there was actually some money being pumped into the system by the Chinese, and that was going to be positive for probably global growth to an extent. And we've seen that benefit with commodity prices have gone up significantly, which has helped miners here. So where are we now? We're still at the mature stages of a bull market. So it will finish one day. When it finishes, look,
guesswork.
Exactly. Yeah. I mean, but as investors, if you're taking a really long-term view, then you write it out. Otherwise, you keep playing the game, and there are some signs of excess, particularly in the domestic market, where some of the valuations of the tech companies have they've performed exceptionally well since December, outperformed the global peers, and we're already seeing signs of them. A bit of rotation of money out of those into more domestic cyclicals. In terms of looking at the Australian economy, the federal, everyone had priced in a Labor win, and the coalition winning. Well, from our perspective, will have some. There'll be some positive flow-on effects from that, and particularly if they get the the tax cut through. Then that could add about $7 billion of additional liquidity into the Australian system, which is nearly the equivalent of a 0.5% rate cut. So we're probably nervous, as we always. We think Trump will eventually do a deal. And then another great book, isn't it? How I
saved the world.
How I saved the world. Exactly. How I saved the world. So we think that'll play through.
Okay. So have you ever invested in an environment where one US president was so significant to investment decisions?
When I started in the market in 1980, I was always taught to, there was a theory that you'd invest along the lines of the presidential cycle, where the first couple of years are going to be the difficult ones. So the market tends to not perform there, and then the last year is a really positive one because they're pumping money into the system
to win the election.
Exactly, and now that worked for the first couple of years in 1980. When I started in the industry, but then it broke down. I think soon after that, in terms of an investment, thesis, in terms of someone having so much potential impact, as in positive and negative, on equity markets, I can't think of.
Reagan had impact, but he had solid policies, and you had to take a position as a consequence.
Yes.
But this guy is changing nearly every day.
Well, on a tweet. I mean, that's right. Like people are deciding what they'll do depending on what the next tweet that comes through. To me, it is bizarre.
All right. So people watching this might be thinking, is Geoff along a lot of cash right now, or is he reasonably short of cash? Invested.
I mean, our cash. I mean, we can move our cash levels up significantly. And during the GFC, we ended up moving to 75% cash. And this is how we invest. We're trying to buy undervalued growth companies, and if we can't find them, but we won't buy them unless we see a catalyst that will change the valuation.
Yep.
So there's a lot of timing in that. So if we can't find them, we'll sit in cash. And when the market was coming off, last year, then we went
December quarter.
Yeah, we went to a little over 50% cash in our mid and small cap fund, Wham Capital.
Yeah.
At the moment, we're a little over 20% cash. We did get down to the end of last month about 18% cash.
Yeah.
We're 23, 24. And that's more, there's been a few more trading opportunities, because when we're sitting cash, we'll look for trading opportunities. If we think the market's...
Get in quickly, get out quickly.
I mean, that's to supplement our returns on the cash.
Yeah.
So where are we now? We're nervous, we're wary. We're still playing the game.
Yeah.
But we have increased the liquidity of our stocks in Wham Capital in the mids and smalls, because if we need to run for the exit, we want to be able to run.
Okay. You always share with me either your latest buys. I like your latest buys because the price wouldn't have risen too much since you bought them. And it might actually help your prices go up by you telling me. But what are some of the latest purchases that you think look like good value? Because it's not that the big caps have been bought right out, I think. And I noticed that the mid caps, like 50 to 100, they haven't been doing so well lately, but
just in the last little bit. They did have a good run. When the whole market bounced back.
Yeah.
Well, one of the things in terms of this is not a long-term play. This is more over the next. Actually, one of them is probably more medium long-term, but the other one is probably over the next few months. Is retail. Now, retail is an incredibly tough business, as we know. We've been buying some Harvey Norman. We just think...
Jerry would like that. He'd love you saying that.
But we just think the market isn't pricing in how well they're going with their overseas business, which is a significant, like nearly 25% of their total business now. They're doing a very good job. And the fact that, the consumer, we think, with that tax cut, we'll see some
positives. And also the rate
positives.
cuts could be 2 or 3 there, couldn't it?
Correct. I think the market's forecasting 2 in Australia. The one that is more is again in retail, which is, as I said, a tough industry and has been really finding it difficult, but is in a sort of, it's under new management, is Myer. And we've...
Well, their online performance is really picking up, isn't it?
Solid, and John King and his management team that have been in there since June last year, they are doing a really good job, and they're taking significant costs out. We could easily see, the stock, is trading in the mid to high 60s, easily get to $1 in the next 12-month period. Even though department store retailing is very difficult, it's a big cost out play that he's doing, and we think he's delivering.
Yeah, and the idea of shrinking the big stores will mean he'll save on his rents. The landlord's going to be happy to keep them in the centre because they're still anchor tenants.
100%, and the landlords are very excited. They're going from say 4 levels, 4 floors to 3 floors. They actually get an enhanced yield on the 4th floor. Myer has less stock. Makes it more efficient. They've been focusing on online more. And each time they do that, they could pull out on our numbers up to $10 million of costs. There's still a lot of costs that can be pulled out of the business.
All right, let's run through the funds you've got, because a lot of people have heard of Wham, but just run through each one and which one you would put your daughter into. If she said, Dad, I love you.
Oh, okay. I thought you were going
to... But what one should I put my money in to make money over the next 5 to 10 years? So when I'm 30, I can buy myself a house. Which is the best one?
Yeah, okay. I thought you were going to ask me which ones I would buy. I mean, what I love buying...
You can do both, you and your daughter.
Okay, because they're two different
of course.
questions. Yeah. Because I love buying... If I can buy $1 for 80 cents, I get really excited. And on that...
Value hunter.
Yeah, and on that, of course...
You're like Steve Irwin of stock market, looking for...
Hey,
hunting. The great hunter.
I'm thinking of getting stabbed now by a stingray. So we've got 6 listed investment companies. Going from the oldest one is Wham Capital, which looks for undervalued growth companies in the mid and small cap space.
That's what you made your name on. You cut your teeth on that one, didn't
very
you?
good, And then that's got a undervalued growth companies, which is a research. We say it's our research part, and then there's the trading, which is just trying to get a return, short-term returns. Yeah. And if you want those direct plays, it's Wham Research and Wham Active. And then as Wham Capital's grown in size, we thought, it's over $1 billion of assets now. So the companies we look at have to be a little bit bigger. So we created another fund called Wham Microcap, which looks at the stocks that are 150 million in market cap.
It's for the speculator, that one, isn't it, really?
No, that's more the smaller ones, just those really small companies. And the fascinating thing about Australia, it's got a big, we've got 2,500 listed companies, but a lot of them, there's a lot of them in that small
and they get ignored, don't
tail.
they?
So there's great opportunities there.
Yeah.
And then we've got a large cap fund, which is Wham Leaders. And then last year we created a global fund, which is Wham Global. And we all have different teams that manage the different pools of capital.
Okay.
So the two...
You and your daughter?
Yeah, the two I've been buying was Wham Global, because it's trading at about a 10% discount. It was trading at a bigger discount. And that's just because it's newish, so it'll take a bit of time for the share register to tighten up. Yeah. And the other one I'd been buying was Wham Leaders, which is trading at about a 7 or 8% discount. So I'm buying $1 of assets at 90 cents or 93 cents. Wham Capital is trading at a premium, so I don't like paying above what something's worth.
Even if it's your own, you want to do it.
Yeah, exactly.
It's so tight, Jess.
But the one I'd probably, if I was buying two stocks for my daughter, I'd buy Wham Microcap, because they are smaller companies, so it's trading around
There's
NTA.
potential for a big upside there, isn't there?
You're taking a high risk, so if the manager's any good, you'd hope there's high returns. But that's sort of a more medium-term view, because the next couple of years, a year could be tough, but then eventually. And the other one would be global, because Wham Global looks for, it's undervalued growth companies, but we tend to focus on mid and smalls on a global basis. So, they're the two I'd buy for my daughter, and the two I've been buying for myself was Leaders and Global, because they're trading at discounts.
Okay, so it's good for the younger and the more mature investor. All right, now, it was a gamble when you decided to take on Billy the Kid, Bill Shorten, with his franking credits. Did you evaluate? Because if Bill had won, you would have been a very unpopular man from the point of view of the Prime Minister.
Incredibly unpopular, and I knew that. And a lot of people said through the process, do you know what you're doing? And from my perspective is, when they announced that policy, March last year, we initially, when I saw it, I just thought how unfair this policy is. And it was not only illogical, but it was grossly unfair or inequitable. And it was illogical, and it blows me away that they actually announced it. To me, it must have been one of their spin doctors said, "Oh, look, let's spin this up and let's announce it this way." Because the logic is, what you want is you want people investing in Australian companies. So that big pool of money in the self-managed super area, you want those guys investing in Australian companies. So Australian companies' equity becomes cheaper than debt. They buy Australian companies. Those Australian companies invest in Australian businesses, so then pay Australian tax, which the tax office gets. And at the same time, they employ Australians, those Australian companies. You don't want...
And it provides consumer income for consumers who then go out and buy stuff to keep the whole economy going.
Correct. I mean, that's what you want. For a Labor government to say, look, we're going to put this in place and we're happy for you to invest overseas because you've got too much money invested in Australia. To me, that is just illogical. And if you're old and retired, your liabilities are all in Australia. And evidently they say, in terms of your medical costs, 50% of your medical costs are in the last year of your life. Do you want to take the risk in having your money in offshore where say if the Aussie dollar goes from 70 cents to $1, you lose half your money. Yeah. So to me, there was the logic was so
dying on the dollar. You could call that.
Yeah, that's right. It was so poor, and then the unfairness, like I just or the inequity. To me, that's what really made me cry because the stories of people that have done the right thing all their life, paid tax, and it was just impacting the people in self-managed super. And individuals.
And their families as well.
Exactly, we're going to miss out on those franking. But if you happen to be the same age and retired and have your money in an industry fund or a union fund, you get the franking back. Yeah. And we estimate that's about 11 billion those would have got back, and they were going to take 6 billion from this group. Like it was just, and the families, and that's what they missed. That's what they missed. And we've just done our 6-monthly roadshow, and in Brisbane, a shareholder stood up and he said, "Look, I've got 11 grandchildren and 3 great-great-grandchildren. Yeah. 7 of them are in voting age, between 18 and 24. And he said, I sat down with them 5 times and I explained them that I started putting my money in superannuation in 1959 and the taxes I've paid and what I've done and I've lived under this system and what the Labor government is going to do, Labor opposition, if they get into government." Yeah. And he said, the 7 of them said they'll never vote Labor again.
I know, it was a very bad thing to put out there. And then, and even Graham Richardson at our strategy day, where we had like 2,000 people, Richo said to them, this rich and poor thing and the franking credit was dumb. And I guess he suffered the consequences.
Because the rich and poor, I'm sure you've got a reasonable amount in your super fund, which I've been fortunate, and I have as well. Yeah. When they capped the super fund at 1.6 mil and charged a 15% tax above that, effectively the big returns or the big franking refunds, they've gone. Yeah. And all the statistics that Labor was using were the 2014-15 statistics, which didn't include that. So they're all incorrect numbers. So to me, it was very disappointing.
Okay, Geoff. One last thing. How long have you owned your business for?
Oh, a little over 20 years.
Okay. Yeah. And do you find, having a business that is so inextricably linked to the markets, where you have to make decisions that could either make or break the company, do you find that a personal struggle at times?
Hey, employ good people that make those decisions for you. I mean, that's what it is. Like I invest a small, I have input to them. I see everything we do. I look at a certain area of the market, undervalued, companies trading at discounts, 10 TAs. I've got a team of 11 investment professionals that love what they do, like myself, and spend all their time looking at the market. So to me, it's just, one of the things is just employ people smarter than you. That's what everyone sort of tells you when you go into business. Make sure you get people smarter than you working for you.
Yeah, exactly right, mate. Thanks for joining us on the show.
Thanks, Pete.
It's Geoff Wilson, a legend of the funds management game. And as you can see, he's not a bad bloke either. This is the segment where I catch up with Charlie Aitken from Aitken Investment Management and my colleague Paul Rickard from the Switzer Report to look at the big themes that might be influencing the stock market. And clearly over the weekend, we got a bit of a shock with Donald Trump deciding to take on the Mexicans. It was actually the genuine Mexican standoff. He basically said...
That's good material, Pete.
I thought as I wrote it, this is actually a genuine standoff. He said, if you don't get rid of your drug lords and you don't stop the immigration inflow, we're going to slam a 5% tariff on all products. Charlie, is this going to be something that could actually end up causing a recession?
Well, I don't think tariffs on Mexico will in themselves cause a recession, but if confidence gets belted enough, recessions are sort of self-serving. They come around as business confidence and consumer confidence falls. I broadly think these are threats that are to get people to the negotiating table. He's been doing it with China, he's now doing it with Mexico, mentioned India on the weekend as well. So it seems a very heavy-handed way of doing things, but inside equity markets, I actually think it gives you an opportunity to deploy some capital. So I see it as an opportunity. I think the Mexican thing was completely out of left field, and that's how the market reacted. Yeah. But inside that, That was known on Friday in futures market trading in Asia. So the futures were heavily down in US futures. And interestingly, today, Asia, with the exception of Australia, is actually quite okay.
Yeah. Well, Paul, what about the China white paper where they're talking about blacklisting American companies? Because the Chinese negotiators seem really cheesed off at Donald's bully tactics.
This is the art of the deal, as Trump wrote. So I guess it's probably gone a couple of steps further than the market was anticipating some weeks ago.
Yeah.
And we've now got to see how it plays out, Peter. But I'm a bit surprised by our market sort of fairly benign reaction to it late last week. And again today, I thought our market might be off a little bit more, simply because we've gone against the trend for the last, the rest of the world's been a bit more worried about trade over the last couple of weeks in the Aussie market. We just had an election and sort of forgot about the trade issue. So we're firmly back into that sort of mindset at the moment now, and we're going to take the lead from the US, Peter. So, look...
is this a buying opportunity like Charlie said?
Not yet. I think it could be. I think you've got to look for this to play out. I doubt you're going to see any hugely conciliatory moves just yet, but, he keeps surprising us, and at some stage you'll think there'll be another move where they'll be sort of friends again. But let's... Yeah. He's a deal maker, Peter, so let it run its course.
They'll be sharing dumplings by the end of June 20. Is June 20?
Yeah, G20 meeting's not far away. I think you'll get something a bit more conciliatory around that. Let's see. But markets are oversold, though, with the notable exception of Australia, which was about the only market in the world up last month for its own reasons.
Hoo-ha!
No, but that might work against Australia in the short term, and it worked against Australian equities today. We've simply done too well in a relative sense versus the rest of the world.
And to put it some context in that, in May, the US S&P 500 was down 6.35%. We're up 1.7%. So that's an 8% swing, Australia versus the US in the month of May. Most of that coming in the back half with the election and also to talk about interest rates. So it's not surprising that we're going to, if this plays out a bit longer, I suspect we're going to move harder than the US.
But we have been shocking laggards because of the Royal Commission, APRA, screwing up the housing sector. We had other issues that have been holding us back. It's a little bit of that catch up as well, isn't it?
It is, but we also got a bit expensive, Pete, to be honest, in the last few bits of last month.
So are banks expensive now?
Well, they got a little expensive. They pulled back about 6% from their highs as well. There's been some quite quick moves back. So look, I just think the way I look at things, I think there's a better opportunity set outside of Australia at this very moment, just on the relative movements and the absolute pricing. So I think I wouldn't be surprised if Australia underperformed in June, even if there was a slight recovery in global markets.
Paul, I've never ever asked you this question, and maybe because you're an older kind of guy, but the tech stock in Australia, sector in Australia has done so well over the last year or so. Do you think it's overbought?
I think it's because we have the scarcity of great tech names is why the Afterpays and Appens and have done so well.
Altair.
I mean, look, I'm sure if we had, if companies like our friend Mike Cannon-Brooks and Scott Farquhar, they had a listing in Australia, it wouldn't be worth as much. We'd have a bit more to choose from, but I think we don't really have a tech sector, and that's why we just followed the US up. I mean, year to date, the tech sector is still the best performing sector. It's up 24% at the end of May compared to the market's about 15%, down about another 4% today. So, look, I think it's just a function of supply and demand, very little supply, and it's got overpriced. But
I think what we need to be a little careful of, though, with some of these Afterpays and Altiums and Appens, is they could be a victim of their own success in the short term as they go into the major indices. So they go from being small cap stocks to being part of the ASX 200, and you often get selling from small cap managers who can't hold them when they're in the ASX 200. So,
will that be a buying opportunity, Charlie?
I find that they're still very expensive the way I look at stocks, and we have a global mandate, so I can look at American stocks, I can buy Atlassian, I can own Microsoft. I don't have the boundaries of Australia holding me to only buy Australian tech stocks. But look, I think you could see quite a big pullback in those names if there's a change of ownership. Or the thing is, though, Pete, there is no margin of safety. If one of those stocks has the slightest mistake, they'll lose 50% of value.
Yeah, and look, and we've seen that just in the mid caps. I mean, you look at a company like Link, down about 30% since Friday.
Costa Group, 30%.
Yeah, Costa Group the same. Reliance came out. I mean, if you get none of those stocks. Those three stocks, they weren't trading on super multiples, not the multiples that the likes of the Appens or the Afterpays were trading, but a bit of a slip, an earnings downgrade.
Let's put you on the spot. Link is a company that you've always liked. Is this a buying opportunity? Because there's a bit of
I
Brexit
think,
in there, isn't
I
there?
think it will be. I mean, again, unfortunately, the Link has proved the rule about Australian companies investing in the UK. Yet another one that has got, I just can't think of the polite words to use, it's all come about when Australian companies, for some reason, they can invest in many places overseas, but when it comes to the UK, 99 out of 100, I'm exaggerating a little bit, stuff it up. And Link is another one that stuffed it up in the UK. Sure, Brexit's an issue, but look, there's other issues there. So, look, it's not a huge downgrade, but the market's punished at 30%. I think it looks cheap, Pete, but
Reliance?
But Reliance is the same. But unfortunately, when you disappoint like this, the market is pretty cruel, and it doesn't easily forgive.
I'll tell you one lesson from it, though. I'll tell you one lesson. Forget Link. I don't think there was any insider selling before the profit warning.
No, there wasn't.
But in Reliance Worldwide, the Munns family sold out it completely a few months before the profit warning. And in Costa Group, the managing director sold, I think, $7 million worth before the profit warning. So
There's been no insider selling in Link, I think.
no, but I think I'm not making any allegation there. I'm just pointing out a fact.
Yeah.
But I think people should keep a close eye on insider sales in this environment. They have been somewhat of a precursor to bad news.
Okay. So
and it's all legal, people.
It's all legal, exactly. But
there is a bit of a case the other way. Insiders can only sell in particular times, right?
Yeah, they get windows.
Most companies have 3 trading windows. It's after their half-yearly, yearly profit reports, and also after their AGM. Usually pretty tight, 3 or 4 weeks. And a lot of insiders own lots of shares and get big tax bills because you've got options being exercised. You've got that there is an issue with insiders, particularly employed insiders, having to pay tax because of the exercise of options or share rights. So there is some defence, and if you get a lot of your assets, which most of these insiders do, tied up in all one company, there's obviously a bit of temptation. However, when you do see the insiders sell, it is a cause to say, hang on,
what's
do
going
they
on?
know something we don't know?
Yeah.
And I say unfortunately, but it tends to be, not always, but often that it's a precursor to something coming out a few months later. So I don't think they're saying it's bad news, but they're saying this is about as good as it gets often.
Yeah, fair enough. Now, all right, what do you like, Charlie? Give us one stock you like after looking at this week of all the things that are going on both here and abroad. What's the one stock you like?
well, I mean, in the Australian context, I'm still pretty not exposed to Australia at the moment. I wrote in the Switzer Super Report last week that I've sold out of Aristocrat and Kidman and a few other things that have done well.
2 stocks you've liked.
Yeah,
for a
they've
long
done
time.
well for us, so that's great. But it's also, they got to, in my view, a full valuation. Doesn't mean they fall, but I think I can put the money to work better elsewhere in the world. So I'm actually been nibbling away in large US tech, including things like Alibaba, which faced China, Apple, Tencent in Hong Kong, which is actually up today. It's some interesting price action. Emerging market stocks, the largest ones, look like they might be bottoming because it just may be that the US dollar's peaking. There's slightly changing expectations about US interest rates, i.e. they could be cut in the not too distant future. And the US dollar had a down night on Friday night, which was interesting and a risk off night. So look, I've been buying large US tech, large Chinese tech, but just slowly putting some cash to work. I think this is a buying opportunity more broadly. I don't think it's the end of the world. I think we've been caught off guard by some escalation in trade wars, but just as quickly as that comes, it could go away. So I think it's a chance to put some money to work at good risk-adjusted entry prices.
Paul, you got one?
Yeah, I had a couple, Peter. What I don't think is good buying at the moment are some of the interest rate defensives. They've got super
I agree with
expensive. Transurban today back over $14. Dexus, they're all up. The yields now, look, you don't just have to be patient. Just get used to suck up 1.25% cash for a while, right? It's not going to kill you, right?
Yeah,
You don't have to go to work with something. I like the stocks, but they got very expensive.
No.
Look, a bit of a contrarian player. I'm worried about whether it's my own value trap I've created, but I've taken a bit of a dabble into BlueScope. It's come down from about $19 to about $10.30. Still margins in the US have been crushed a little bit. I don't know, Peter. I just think there might be a bit of
It's
value.
been a company surprise every time
it has
the
surprised.
price has gone down.
The market is expecting an earnings downgrade on that, so
Yep.
that's probably still ahead of us. Whether that's fully priced in, I don't know, but there's a stock for a little bit of control.
Well, that's like similar to me buying Apple or something like that. I mean, Apple's down 18% in a month. The analysts are all writing that if the trade war escalates, it'll take 20% off their earnings. Well, the stock's down 18%. It's got a $100 billion buyback program. It's got $250 billion of cash. Should I be buying that stock? I think I should be. So the market pays you to take risk occasionally. And things like BlueScope, I don't necessarily disagree with. I mean, the stock's been down almost every day for 20 days. So I think
they're doing a buyback.
Yeah,
so,
correct.
Look, I mean, I'm not saying it's that you get it.
It's out there, Paul, now.
I'm not saying
You've said
bad
blue
news is not
sky.
going to come out and it won't get slapped a bit, but
Yeah.
I think it might be one for the long term.
Okay, so you got the insights from people who think about the market 24/7. They've got nothing else in their life. But that's why I talk to them all the time. Thanks for joining us. That's the show for tonight. Thanks for joining us. I'm Peter Switzer. I'll see you next week.